Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. Seems like the dollar bulls had some more reason to celebrate on Friday night with the PC numbers coming in higher than expectations, cementing the narrative of higher rates for longer. Emerging market currencies continue to weaken against the USD, and CNH seems to be leading the pack. JK, what are your thoughts? How are you reading the PC numbers, and what's your outlook for this week?
Yeah, good morning. Really, markets were rattled by Fed's preferred gauge of inflation coming much hotter than expected and almost erasing the disinflationary scenario that Powell had painted earlier in the month. And following the recent data revealing stronger than expected US labor market and solid retail sales in January, market was bracing in for a round of solid US data releases on Friday, but the degree of strength was bigger than anticipated. Real personal spending rose 1.1%, strongest monthly gain since the pandemic government handout in the month of April 2021. Then the accompanying inflation report also painted higher, as you said, PCE deflator jumping 0.6% per month, as its highest reading since July 2022. The annual increase was 4.7%. That was 4 tenths ahead of market's expectations as the data showed upward revisions. So it's not just the sustained higher inflation, but also the robust economic activity depicted in the recent data that has made the market accept reality of higher for longer, with the terminal rates now going up to 5.5%, 3.25% increases in March, May, and June, and some hawks even go to the extent of calling for 0.5% hikes once again, but that's on the extreme. But most people still want to go for the 0.25, but up to 5.5%. The repricing of rate hike expectation was not limited to the Fed. Even the ECB rate hike expectations also ratcheted up, triggering a global bond sell-off led by a rise in front-end yields and flattening the yield curves. As I said, other data were also very strong. University of Michigan consumer sentiment at 67 versus 66.4 last month, and it was at the highest since January 2022. Housing market showed some signs of stability with building permits increasing by 0.1% versus a contraction in December. 1 year ahead inflation expectations also rebounded to 4.1% from 3.9%. Surprisingly, Fed members who spoke were not as hawkish as their statement would have been normally after such a data. Mr. said rates have to be somewhat above 5% and hold there for at least some time in order to get inflation on a sustainable downward path. Even more surprisingly for me, later St. Louis President Bullard was on the tape sounding like the Fed's job is getting closer to being done. And Bullard suggests that markets believes in Fed's credibility after the rapid rate hikes, and also described a huge fiscal spending like global war that was combined with accommodative monetary policy, eventually, getting into a new regime of, fiscal plus monetary policy working. So basically, 5.5% terminal rate along with the fiscal tightening is what is expected to ease the inflationary pressures. And also what I feel from the overall perspective is that one higher interest rates beyond 5.5% is likely to put the treasury in a much more difficult position, because they are already paying a huge amount of interest cost on their huge borrowings, and also they would have to ensure financial stability. If they take rates too high, then corporates as well as the economy will definitely go into a tailspin. So I think all said and done, it may be 5.5 and a long pause is what I think. Obviously, markets took these things on their chin. European and US equities were in the red. S&P 500 fell over 1%, extending weeks declined 2.7%, the worst weekly return in 2 months. Tech-heavy Nasdaq fell 1.69%, losing 3.3% on the week. Europe, it was holding very well, also fell 1.04%, 1.04% on Friday. with the 1.4% loss for the week. On the yields, we had it was really cratering impact, shorter tenor rising sharply and inverting the yield curve even more. And US 2-year yield reached 4.83%, highest level since 2007. And benchmark yield closed the week at 4.814, up 12 bps in the day. Germany's 2-year rose to 3% for the first time since 2008. We are talking about the rate prevailing before global financial crisis, and closing up 12 basis points, at 3.03%, while 10-year gained 9.7%, 2.4. So it's all across. Bond yields have risen across, and that probably is the reason why the dollar index did not show much of a rise, and the rise of yields in Europe, UK, as well as in US means that dollar is not the only beneficiary. Even these currencies are benefiting a bit. So Euro's losses for the day were not as steep as one would have expected. In fact, sterling has held up much better. The currencies which stood out with more losses were yen, which was already struggling after the new nominee Ueda's statements, which was almost towing the lines of the previous, lines, and then the higher yields across Europe, US, and UK invited more yen selling in carry trade. Aussie dollar was the biggest loser, and it has lost more than 4% for the week, as it follows not only the higher US rates, but also the fact that Chinese yuan has been weakening quite a bit. Chinese yuan itself was an underperformer during the last 2 weeks because China rates are not going up. They are actually slowly inching down as the government looks to support the economy, whereas the US rates are going up. The differential between US and China widening actually keeps the Chinese yuan on the defensive. All in all, I think we should not look to see a dollar going into a very big rise, at least for now, because the evolving monetary policy environment should be kept in mind for all the countries. Hence, the dollar gains may be limited to not more than 1% from the current levels, where the technical resistance lies on the chart. However, should dollar manage to break through 106.50, we should expect it to touch 108 levels, where weekly resistance lies. On the rupee, Friday, we saw once again the range trading hold, but then it's a very clear pattern. Any gap down open invites good bids, and any gap up open invites good selling. Apart from what we have been hearing about central banks' strong actions, once again on Friday in offshore market, we saw almost 82.98 being traded, but since then it has dropped back below 82, 90. Continue to expect in this range, but slightly speaking of medium term, while we have had some good news on the deficits and BOP estimates are getting downsized, we still don't see the big flows which would actually influence the rupee on the higher side. Therefore, we cannot see rupee making much out of any even dollar weakness that might emerge until we see the outflows for the rupee. So yeah, that's it for the day. Have a good week.
Thank you, JK. And just to summarize, we saw PCE stronger than expectations, and also a strong labor market and retail sales data, which cements the higher rates for longer narrative. And we are also seeing a rebound in inflation expectations. While for terminal rates, 5.5% is what is being expected, 5.5%, and a pause. After Friday's data, we saw some sell-off in global stocks, while on the domestic front, rupee continues to trade in a range while central bank remains active, even in the offshore market, to contain volatility. That's it for today. Thank you so much for listening. We'll catch up again tomorrow with another round of fresh updates. Thank you.